All right. So, hello everyone. Again, my name is Spencer Barrett, and I have this week's video for all of you here. I had chapter 8, exercise 11, and you can find that in the end of homework section of chapter 8. I have all the information already written down here just to kind of speed up the process. But if you do have any questions, again, just leave it in the discussion board. But for this problem here, sorry, we're supposed to journalize notes receivable transactions. So what we have listed here are the three transactions, pretty simple, took place in 2016. And the instructions say record the transactions in the general journal. The company does not make entries to accrue interest except at December 31st. So I already set up the basics here and let me kind of explain. So obviously the first entry is going to be on May 1st. We are receiving a $5,000 note and from our Stony, and that is their accounts receivable. The 31st, interest, interest receivable, and then interest revenue for our Stony. And then on May 1st, we essentially want to pay off whatever note we had. So we have cash and then notes receivable, interest receivable, interest revenue. So to start off, notes receivable, we incurred a $5,000 note, and then accounts receivable for our Stony be 5,000. Interest receivable is a little bit different. So from the 1st of May to the 31st of December, that is a total of 8 months. So what we want to do here is 5,000 times 6% times 8 divided by 12 equal $200. And then that would also go $200 in interest revenue. So pretty basic there. The reason that we did this formula here is because it's a $5,000 note. And again, the instructions say here, interest accrue at December 31st. It was at 6% rate, and it was 8 out of the 12 months. So it would total $200 on each here to balance out the ledger. So the next part here is going to be the cash. Now we don't know the total cash just yet, simply because that's going to be all three of these added up. So notes receivable, we do know that is still 5,000. That doesn't change. Interest receivable would be from last year, so that's the $200. And then interest revenue. So from December to May, if we pull up the calendar here, obviously. All right, so 1, 2, 3, 4. So 4 months. So we want to make another equation here that says 5,000 times 6% again times 4 out of 12 to be $100. So just essentially cut that in half. So since we are paying off the entire thing, the amount of cash that we would need would be $5,300. And that is how you would journal all of the transactions from above. If you have any questions, again, just the discussion board, it works for fine.